Well, good morning, everyone. I've got 10 o'clock, so it's a beautiful Friday, and most of us are in Montana, so I know we want to get moving on this so we can all go enjoy the weather. My name is Riley Meredith. I'm the Marketing and Communications Director here at the Montana Community Foundation. Today, we'll be having our general and investment update. The two presenters you'll be hearing from today, first will be Mary Rutherford, who's our President and CEO, who will provide a brief general update. And then you'll be hearing from Omar Sanchez from Cambridge Associates. He's their Chief Investment Officer, and he'll be running through the recent investment performance of the funds they have on behalf of MCF. A few quick housekeeping items. We would appreciate if you could mute your line for the time being, just so we don't get any background noise. And to do that, you can either do it through your computer audio. If you're calling in through the phone, you can do it using *6. *7 is what you use to unmute your line if you have any questions. You can use the chat function on your computer if you have any questions, but you're also welcome to wait until the end of the webinar, where we'll provide some time to answer questions. I will try to monitor that chat in case any of you have any questions during the presentation. And please know that this webinar is being recorded. We will put that up on the Montana Community Foundation website once the webinar is concluded, in case you'd like to go back and reference anything, or of course for folks who aren't able to join us live today. So first, we're just going to get started with the MCF general update. So Mary, if you are on the line, I will hand it over to you.
Thanks, Riley. Can you hear me okay?
Yes.
Oh, excellent. Thanks. So welcome, everyone. We're really pleased to have you joining us today. It's been a bit of, I guess, a little while since we've had one of these webinars, but we're really excited to be relaunching our webinar series, and pleased to be presenting some great information to you today. Just make a mental note, if you will, that we plan to do these now twice a year, these investment webinars, typically around this time, late May, early June, following the close of the first quarter of the calendar year. And the next one that we'll have will be likely the first week, I believe we decided the first week of December. Am I still on, Riley? I just heard some, yep. Hello?
Yep, you are. Go ahead, Mary. It's just some folks joining in late.
Oh, okay. Sorry about that. I'm getting used to all the reused to the technology. So we're really pleased to have you joining us. Look forward to having you participating or listening into future webinars. You know, this has been a kind of a pivotal year for us at the Community Foundation. We're thrilled, over the moon, in fact, to have achieved one of our huge internal goals that the board set 4 or 5 years ago when they finalized our strategic plan, and that is, you know, to be of service to Montana. And the way that we're quantifying that is valuing the total dollar of assets under our management. So in total, permanent, endowed, and non-permanent funds, we surpassed our goal of having $100 million under management. And as you well know, very little of that actually directly benefits Montana Community Foundation. Most of those funds are designated to specific nonprofit organizations or other family donor-advised funds, et cetera, across our state. So we're thrilled to have reached that milestone. In so doing, it didn't happen just magically. It happened because of the hard work and dedication of our board, our staff, and a huge part of that is our stellar investment performance. So we have a full staff now. We don't anticipate, frankly, any changes organizationally. We have, as you all know, we have our office up in the Flathead, we have our office in Missoula, and then we have our main offices in Helena. and we are fully staffed and not anticipating, frankly, much more growth, and really in terms of staffing and focusing on stabilizing our organization and focusing on some of our internal processes over the next couple of years. So with that, we're happy to have you joining us. Our whole goal is to be of service to this great state, and we couldn't do this great work without your support and confidence in us, as demonstrated by your charitable gifts to the Community Foundation for the benefit of Montana. So with that, I'm going to segue right over to Omar Sanchez. You may recall that almost 2 years ago now, we transitioned investment firms to Cambridge Associates, and we've been really pleased with the performance results. But I think even as pleased with the results of the investment itself, all of our investments with Cambridge has been the incredible team that Cambridge brings to the Community Foundation to serve Montana, and that's led by Omar Sanchez, who serves as our Chief Investment Officer. We like to think of him as ours, even though he's really Cambridge's. But his experience and background and his team spirit have just been incredible additions to our finance team and our whole organization. So with that, Omar, welcome, and thank you for joining us today.
Thank you, Mary, and it's really great to be here, and I am your CIO, just to be very clear about that. It's great to be here this morning, and in terms of what I thought would be helpful to cover from an investment perspective, there are really sort of 3 items on the agenda, if we could go to the next page. And that is one, just as a reminder, a very brief background on Cambridge Associates, who we are, what we do. Secondly, we'd like to review our investment approach. What is our philosophy? How do we think about managing portfolios? How do we build portfolios? And then the third, of course, is just an update on markets and an update on the portfolio, both in terms of performance and positioning. I will certainly try to do my best to keep my comments relatively brief, and certainly so that we can allow time for questions toward the end of the presentation. So first on Cambridge, we are a global investment management firm. For those of you who are less familiar with us, we were founded in the 1970s by 2 gentlemen, Jim Bailey and Hunter Lewis, who were grad students at Harvard University. And their initial sort of work as part of this firm was to do a research project for Harvard University related to just broader endowment management. And from that, spun additional work into consulting with other institutional clients. And ultimately, if you fast forward to today, we work with endowments and foundations, we work with pensions, private clients, governments, and insurance companies to help them manage their investment portfolios and ultimately help them achieve their goals so they can really maximize the impact they're having on the world. So if you take a look at the next slide, this is our team. As Mary mentioned at the start, I am your Chief Investment Officer. I'm a Chief Investment Officer at Cambridge Associates, and technically I'm part of what we call CA Capital Management, which is our outsourced discretionary investment management business. So I am the CIO for the foundation, for the foundation's investment portfolio, and together with my team, we manage the portfolio on a day-to-day basis. What that means is that we are making all of the investment decisions in the portfolio, hiring and firing managers, rebalancing, etc. But we do that within the investment guidelines, or the rule book, if you will, that is set and formally approved by the investment committee. So that really is our playbook for how we ultimately run the portfolio on a day-to-day basis. So let's take a look at our investment philosophy on the next page. And it really does begin, and it's really based on a long-term investment horizon. Quarter to quarter, you'll have performance, and sometimes it will be good. Sometimes it will probably be not as good as we would all prefer. And we are very much aware of that, and we certainly monitor performance extremely closely. But to be successful, we really believe you need to take the long view. And to do that, you need to have a strategy that you can stick with through the inevitable market ups and downs. And there will certainly be ups and downs in the markets, as we all know. And to be very clear, this is a strategy that's not about avoiding the next bear market. It's about withstanding the next bear market so that you hold the line and you don't sell and you're there when markets recover, and you can participate when markets indeed recover. And so we spend a lot of time at the front end of the relationship, and we did this with the Foundation's investment committee early on in the relationship, and we revisit this on an annual basis, making sure we understand the needs that you have from this broader portfolio of assets and the willingness that you have as an institution to take risks to ultimately achieve those objectives. So it very much is an approach that is custom to your unique needs and your unique risk tolerances and preferences. We do believe in active management when we think we'll get paid for it on a net of fee basis. And if we don't, then we're perfectly happy to index in the portfolio. And in fact, we have roughly 15% of the portfolio indexed today. We do not market time. We think that very few people, if anyone, is actually good at that. And if they're good at it, they're only good at it for a very limited basis. We really haven't found anyone that's good at it on a consistent basis. And the cost of being wrong can be very significant to the portfolio. So instead, what we'll do is lean in to assets that we think are more cheap, more attractively priced, and we will lean the portfolio away from what we think is a bit more expensive. And we do that to try to add some incremental value above your policy benchmark. But to be very clear, we expect the vast majority of our value added that we hope to deliver to you over time to come from picking managers that ultimately outperform their benchmarks. And then lastly, sorry, go ahead.
Omar, I have a question from John. He asked, against what firms do you benchmark your returns?
So we benchmark our returns against broad indices. So for the equities, for example, it'll be things like for the U.S., the S&P 500 index, the non-U.S. MSCI World ex-U.S. index, hedge funds, the HFRI Fund of Funds Index. So we're not benchmarking against other firms. We're benchmarking against broad, either market or in the case of the hedge fund, sort of manager benchmarks. Okay? So the last piece is risk management, and that is really not a model. It's not a tool. Believe me when I tell you we have many models and many tools, and we use all of them all the time. But it's really rather a mindset, and it's really something that I think of as kind of a key component of our overall investment process. And it starts, as I mentioned earlier, by getting to know you, understanding your ability and willingness to take risk. It's reflecting those preferences in the investment policy guidelines that you ultimately approve, and again becomes our rule book for how we manage the portfolio. Includes things like strategic asset allocation, ranges, position limits, liquidity constraints, etc. Risk management is also how we think about building the portfolio to ensure that we maximize diversification across strategy, across style, across sector, across cap. And then it's also how we think about position sizing so that we make sure that no one position determines success or failure. And then lastly, yes, it is monitoring the positions that we have in the portfolio and making sure that we're working to mitigate any unintended bets that we have relative to where we want to be positioned. So it's something that's very comprehensive, it's holistic, and it's integrated into everything that we do. So how do we build portfolios? This is the next page. For clients like the Community Foundation that are looking to ultimately grow the long-term purchasing power of the portfolio, to grow the portfolio, we build equity-heavy portfolios across both public equities and private investments to really drive that portfolio growth. And then what we do is use what we refer to here as diversifying strategies. These are a mix of traditional long-short equity, event-oriented hedge funds, and some more liquid, less correlated strategies to really help us reduce total portfolio risk in a way that we can ideally give up less upside, than if we were to just use bonds to play that role. So we think they're a more risk-efficient use of capital, if you will. And then lastly, we build in an allocation to assets that are meant to provide us liquidity in more challenging macroeconomic environments, to provide liquidity to support spend. And the two that we're primarily concerned about, because they can really impact particularly the equities in the portfolio, are periods of sharp, unexpected inflation and severe economic contraction. And so we hold assets that are designed to hold their value and ideally appreciate in those types of environments to, again, help support that spend. So it would be things like commodity futures within the inflation hedge, as well as inflation-linked bonds, and treasuries within the deflation hedging allocation. And then if we take a look at the next slide, we are very much, as you would likely expect, big believers in diversification. What this shows you essentially is annual performance top to bottom across different asset classes, from the best at the top to the worst at the bottom, since 2003. And as you can see, asset class performance rotates. It can be very difficult to actually predict which will be the winner in any given year because it rotates. And so what we try to do is build a portfolio with exposure to a variety of these different types of return sources so that ultimately we can deliver a more consistent and smoother return. And then lastly, if we think about market timing, I mentioned we don't do it. The reason why we don't do it is because the cost of being wrong can be severely damaging to the portfolio. So what page 12 in the presentation shows you is the long-term annualized return of the S&P 500 on the left-hand side over the last close to 40 years, give or take. And as you can see, it's compounded at just under 12% a year since that time. Now, if you were to just take out over that time frame the 10 best days of the S&P 500 over that time frame, your return would have decreased by 210 basis points. So in and of itself, that's a pretty material decline. But just to quantify that for you in dollar terms, if you were to have a $1 million portfolio and you had invested it in 1980 and then compounded it at 11.6% versus 9.5%, that's a difference of $30 million. So it's significant. And again, that is why we don't believe in market timing. We don't do it, and we really don't think anyone should. Okay, so we'll spend a few minutes talking about the markets. I will highlight the first quarter and provide a real-time update as well verbally. But just to review the first quarter, clearly it was a tougher quarter for risk assets broadly defined, and I'm particularly referring to global equity markets. That indeed followed, and I think it's important to acknowledge that it followed a pretty banner year in 2017 across most major equity markets, 20-plus percentage point returns across most primary markets. What were the drivers of that? Clearly, there were concerns over the prospect of rising interest rates, rising inflation, increasing escalating trade tensions, particularly with China, as well as the potential for some increased regulatory scrutiny on tech stocks like Facebook, if you recall, towards the end of the first quarter. In addition, we obviously saw weak returns from fixed income markets as rates ticked up, and that was driven clearly by the Fed moving forward with its interest rate hikes, as well as some concerns over the potential for additional pressure on bonds as the Treasury continues to issue treasuries in an environment where the Fed is no longer buying these assets. And so concern over increased supply putting upward pressure on rates. Now, if we think about the volatility in the quarter, I think it's important to put it within the context of really the last year to 2 years where volatility was, quite frankly, unprecedentedly low. And so we did indeed see it spike in the first quarter, but if you actually look at that volatility within the context of historical volatility, what you'd see is that it's actually more in line with the long-term average, believe it or not. I think the reason that it was particularly jarring, if you will, was because it followed a period of quite low volatility, but it's actually more normal if you look at it within the historical context. And I've said this to the investment committee as well, but I actually think that's a good thing because it's important for investors to remember that there is indeed risk in markets. In any case, if we think about sort of the broader macroeconomic data, the global economy, as well as earnings, both remained quite healthy in the quarter and continue to remain reasonably healthy today. I think you could make the argument that on the margin there's been some softening, but overall, clearly, we are in an expansion mode from a growth perspective, and earnings continue to look quite strong. So let's look at market returns. What we're showing you is market returns across the kind of the broad major asset classes that we have exposure to in the portfolio. The solid bar for each asset class is the return for the first quarter. The sort of hashed bar for each asset class is the return for the calendar year, 2017. Again, just for some slightly longer term context, if you will. So clearly, definitely a more challenging quarter across global equity markets, as well as bond and commodity markets. Fast forward to today, we've seen some better performance, particularly coming out of the end of May. Looking at the quarter-to-date returns, and these are, I'm just going to give these to you verbally, they're not on the page. For the quarter, global equity markets are up 3.3%, and now for the quarter, and 2.3% for the calendar year to date. U.S. equity markets are up 5.3% for the quarter, and 4.5% for the year. And non-U.S. markets are up just under 2% for the quarter and now are in the black for the year after having been negative for quite some time. And essentially emerging markets are roughly flat for the year following a more challenging May. So we have seen markets give back or deliver some more performance after a more challenging first quarter and somewhat of a mixed May. Okay, so performance. This is total performance of the portfolio since we began managing it on a discretionary basis. The start date of our track record is August of 2016, so we're not quite at 2 years yet. As you can see out of the gate, we were essentially flat relative to the benchmark, and then in 2017, very strong absolute return, and on a relative basis added about 90 basis points of value. And just to be very clear, that is net of manager fees, and that is net of Cambridge Associates fees. So it's net-net. In January, we had a very strong month and got some decent relative outperformance for the month. Unfortunately, we gave back quite a bit of that in February, as did the broader market, and in March. But just given the relative performance that we had overall for the quarter, we were slightly down for the year. I'd call that almost flat, down about 20 basis points against the benchmark that was down 80 basis points, so about 60 basis points of value. And so if we look at our performance on an annualized since inception basis on the far right-hand side, you'll see that we're just under 10% compounding against the benchmark at 9.5 for about 40 basis points of value net-net. So on page 16, what we're showing you is a slightly more detailed look at performance by asset class in the portfolio. Overall, if you look at global, U.S., developed ex-U.S., and emerging, we got some decent relative performance there, and then essentially in line with our diversifying strategies, our TIPS, or the inflation-linked bonds, and our treasuries. Where we had some underperformance came from our commodities futures. We have an active manager within that allocation. They had an overweight to industrial metals where they think the supply is quite constrained and therefore the demand should put the prices up for those assets going forward. They were clearly impacted by the ongoing trade escalation, trade tensions, if you will, with China, and so they underperformed for the quarter. I would note the impact on relative performance was about 6 basis points, and that is a function of how we size that allocation at about 2.5% of the portfolio. In any case, just in general, as a reminder, this is why we diversify clearly, because at any given point in time, there will be things that are working in the portfolio and things that aren't. But overall, on a relative basis, a decent story for the quarter. And if you look at the since inception on the next page, I think that's a pretty good story so far. Overall, across public equity markets, delivering fairly attractive absolute returns for sure, and on a relative basis, fairly attractive as well across those public equity categories. We have within sort of the areas that have been more challenged, certainly on a relative basis, diversifying strategies. We've made money there, but we've lagged a bit, as well as the commodities. Again, those two parts of the portfolio haven't kept as much pace relative to the benchmark. Over time, we certainly expect they will. Again, this is important why you diversify the portfolio, because there will be pieces that aren't working at any given point in time. But overall, particularly given the performance that we got from the public equities, that has really driven the relative performance that we've seen on a since inception basis. And so lastly, this is a look at the asset allocation for the assets that we manage, just under $75 million as of the end of the first quarter. We show the split across global, U.S., et cetera, the different investment categories in the portfolio, the actual capital allocations that we have to these investments in the portfolio. And in terms of how we're positioned, we are targeting a 1.25 underweight to U.S. equity markets to fund a 1% overweight to developed ex-U.S. equities and a 0.75% or 0.75 of a point overweight to emerging markets equities. And we're doing that based on our view of the relative valuations, particularly of U.S. equity markets relative to non-U.S. equity markets. We think that U.S. equity markets are increasingly expensive. It doesn't mean that they can't continue to deliver decent performance, but given the prices that you're paying for these assets relative to prices that you could be paying for non-U.S. markets for a decent level of similar earnings growth, we think there's an opportunity to tilt the portfolio a bit towards those assets and ideally generate some additional value here over time. And then the only other tactical positioning, if you will, that we have in the portfolio that we're targeting today is an underweight to treasuries, 1 percentage point to fund an overweight to cash. We think there's likely the potential for some upward pressure on rates going forward here, and so we're expressing that view by moderately shortening our duration within the treasury allocation. And those were the main comments that I wanted to make, and I am more than happy to answer questions.
And again, folks, if you need to unmute your line, it's *7 to unmute.
Just put it in the plate.
Anyone have any questions?
John, are you satisfied? This is Millie.
Can you hear me?
Yes.
Yep, we can hear you, John.
Excellent. Yes, I am. Thank you very much. I was being lazy and hoping I could find out if there were firms against which CA compares themselves, so I wouldn't have to go in and look at all the other benchmarks for the markets. One other question. Will Cambridge Associates be taking more of Montana Community Foundation's assets under management? I think we just saw that it was $74.5 million of the $100 million that Mary had mentioned. So given this stellar, as far as I'm concerned, performance, will there be more CA assets under management for Montana Community Foundation? That may be a Mary question.
Hi, John. This is Mary, and yeah, I'm happy to answer that. So recall that Cambridge manages only our permanent endowments. So of the $100 million, approximately 90 is permanently endowed. We have about $5 million remaining at Merrill Lynch that were part of the portfolio that we had there prior to switching over to Cambridge that are held in longer-term investments that we aren't able to move yet, but when we are able to move, we will move those. And the remaining amount, we have a program at the Community Foundation called Partners for Montana's Future, where families that wish to make charitable gifts but leave those funds with the professional advisor that they've had those funds with, in many cases, for many, many years. Those advisors can apply to become part of our program, Partners for Montana's Future, and with investment committee approval, those funds, legal ownership of those funds transfers to the Community Foundation, but the investment of those has to comply or be, I guess, in a compliance with our the structure of our asset allocation, but they remain at various partners across the state. So those are in-state brokers that hold the remainder of those funds.
That's great. You're ahead of the curve there on medium-sized community foundations, so I congratulate you on that. And I'm satisfied. Thank you very much.
Thanks, John. We appreciate it.
Any other questions from anyone?
Great job.
Thank you very much. If there aren't any other questions, I'll just remind you, a webinar recording will be available on our website. The URL you can see up there on your screens if you'd like to check that out later or share it with anyone who wasn't able to participate. If there aren't any other questions, then we'll say happy Friday and hope everyone has a wonderful weekend, and thank you for joining us.